Hello all CMA final students. Welcome to SCM Marathon for December 25. We are in QT portion and right now we are covering business forecasting models. Part 2, this is part 1. We have completed regression equation model questions. Now we are moving to the next part. So if you see your part 1, in part 1 we have concluded with simple linear regression problems. So we have only done simple linear regression in our first part. Now we will be covering multiple linear regression as well as time series questions also. So most important in this particular topic, that is business forecasting models, going by what is covered in the previous attempts. So mostly is covering either from exponential smoothing method, that is one he asked. Other one is which is part of your time series, right? And another question which is also covered is from time series only, right? So mostly they have been covering from time series, but I hope this time the trend might change. So let's quickly recap what we have covered in part 1. In part 1 we understood what exactly is forecasting and where is the situation for applying this forecasting. And forecasting can be done using qualitative methods, even quantitative methods. So qualitative methods, we have listed out all of them. We have not gone through each one individually, but overall all these are opinion based. So for example, if you take this barometric method, so they consider indicators in this method. Alright. Now survey method, in this based on the questionnaire given to customers, the questions asked to customer, from their feedback, then they will forecast. So like this we have qualitative methods where no calculation is involved. Now most important part is the quantitative. In this already we covered, we have two in this quantitative methods. One is regression, other one is time series. In this regression we have again two types, simple linear regression, other one is multiple linear regression. Simple linear regression, as you all understood in first part, where we are trying to draw a relationship between two variables. First we will draw a relationship between two variables, then we will set an equation. Through equation only we will derive the forecasted values. Through that equation only we are going to derive the future values. So what is the equation here? The regression equation. So you have two types of equation because we have two variables. Depending on which one you are taking x, which one you are taking y, we can have two types of equation. That is type 1 is y on x type, other one is x on y type. So y is equal to a plus bx, other one is x on y type is x is equal to a plus by. Okay, generally these regression equations will look like a straight line equation. Now in this equation what we have to do is, in order to find out this a and b, right? So in order to find out this a and b, what does this a represent, what does this b represent? Already we have seen a represent the intercept, b represents the slope of the line. So to find out this, what we do is we form the normal equations. What are those equations? These are the normal equations. So here also how we form these equations also I told you here, simple technique. So summation of y is equal to na plus b summation x, this is the first equation. Other one is summation of xy is equal to a summation x plus b summation x square. So these two equations, what you have to do is, in this which data we require is, n is number of observations here, summation of x we require, summation of y we require, and summation of x square also we require, summation of xy also we require. So accordingly we set out our columns, then we will find out the data. So here one of the variable will be x, the one of the other variable will be y here. So these are small y and small x, whereas in the equation whatever we are taking is, that is y is equal to capital Y. This capital Y represents the forecasted values. Right. So we'll solve these two equations, this one and this one, to get a and b values. Now we have one more also regression equations, one more alternative also we have. So that is when you take deviations taken from arithmetic mean of x and y, then you can also use this one. Y is equal to a plus bx can be written like this: y minus y bar is equal to byx into x minus x bar. So byx, how to calculate that, that also I gave you. And other method using correlation also we can calculate this byx. Similarly for x is equal to a plus bx also I gave you what is the equation and how to calculate this correlation bxy using correlation coefficient also I have given. So both the methods. So here in fact if you remember in part 1 some MCQs also, especially I told you that some MCQs are based on alternative 2 only. You can solve those MCQs based on alternative 2. So if you remember in that one of the MCQ we did not spend enough time there because of short duration we had. I told you that I am going to cover in part 2, especially that MCQ. Which MCQ that was? MCQ 26. Yes, MCQ 26 we were covering. I told you that in part 2 I will give you the answer for that. So that question is based on again this one only. How we calculate this bxy or byx, based on that only we can calculate that. Here I told you R is correlation coefficient between x and y. Correlation coefficient between x and y here. And how to calculate this R is correlation coefficient. This is one of the method using the geometric mean. This is how we can calculate the correlation coefficient. R is equal to plus or minus square root of byx into bxy. Just multiply these two, byx into bxy. You will get correlation coefficient. So here if you see MCQ 26 in your CMA material, this is what I told you that I will be covering in part 2. For the regression equation, there are two regression equations here. Y is equal to this one, other one is x is equal to, they have given values here. That is, so this we can take it as this is b, this is a. Here again this is b, this is a in this equation. Now the arithmetic mean value of x and y are nearly. So here what they are asking you to calculate is arithmetic mean values, nothing but x bar and y bar. Which one they are asking you to calculate is x bar and y bar. That only we call it as arithmetic mean. Mean value of x and mean value of y. So in regression equation generally x is equal to x bar, y is equal to y bar. In regression equations your x is equal to x bar and y is equal to y bar. That point if you know, then you can get this answer. Question number 26. Regression lines pass through point of averages. The lines whatever we are drawing, that line pass through the averages. So that is the reason your mean, your average and your x value both are same for these regression lines. That is what you need to know. Once you know this point, x is equal to x bar, y is equal to y bar, then whatever equations they have given here, y is equal to 0.516 plus 33.73. So what you can do is you can solve these two equations, solve 1 and 2 for x and y value, get x value and y value, x only x bar, y only y bar here. That is what we have done here, equation 1 and 2. So what I have done here is this x is equal to equation is substituted in x value of first equation, then I got y, then after that substituting in first equation again I got x value. So x is only x bar and y is only y bar, 67.6 and 68.6. So in this, the first option is the correct answer. Right, students? So even 27 also you can answer using our formula, this one. What exactly is 27 requirement is regression line y on x. They are asking regression line y on x. So using this y on x means you can use this only, this first one. Y minus y bar is equal to byx into x minus x bar. How to calculate byx also I given this formula, you can use here. This one. And you can get the answer. Okay, so as promised, I have shown you in part 2 that MCQ also. And already we have done illustration number 1, simple linear regression. 2 questions we have solved. Now we will move to multiple linear regression. Illustration 2 also we have done. Important one this is. Now we will move to multiple linear regression. Multiple linear regression. So multiple linear, what is the difference between simple linear regression and multiple linear regression is, here we try to draw a relationship between one with many variables. See here, this equation is to determine relationship between multiple variables. So that is the reason this name has been given, multiple linear regression. So the relationship between the crop yield, that depends on what? The soil, type of soil, the seed, and the climatic conditions also. So what is the relationship between these with what? The yield. So based on that relationship, we will set out an equation again. Then we will forecast the values. And another example also I have quoted here. What is the relationship between salary? So this is one to many relation. Earlier when I gave you chart between simple linear regression and multiple linear regression, simple linear regression is one to one relation we are trying to establish there. Whereas in multiple linear regression, one is to many, one variable with other variables. So that is the difference. So again, salary depends on what? The educational qualification, the experience. These are the factors now. So again, when you try to draw the relationship between salary and this one, again it becomes multiple variable relationship. Alright. So what is the difference between simple linear and multiple is, only thing is here we are trying to draw a relation between one with other variables. So how to represent in the form of an equation? So this is the first one, that is y on x type. So y on x type, how it is represented is in multiple case, y is equal to a plus bx1 plus cx2. So x1, x2, because I am assuming here only 2. If you have 3, naturally one more also will get added here. So again we have to find out in this also. So remember, this is the equation. Y is nothing but what? The independent or dependent? Dependent. So we have to forecast the forecasted value here. So again we have to find out a value, b value and c value. To get this a value, b value and c value here, so supernormal equations we have to solve. Right? There is another alternative also, like simple linear we have another alternative also, but that is slightly complicated. So instead of that you can use this one, even though it is time taking, but you can assure of the answer what you get. Whatever answer you get, you can be assured of that. That is the reason you can apply this one. So how to get these 3 equations? So 3 equations you have to form. How to get those equations? First equation is apply. How do you get first equation? It is take this equation, apply summation on both sides. So you will get summation y, summation of a. Summation of a, how you can write? N summation a, I told you. Then b summation x1, c you can take outside, and summation x2. So applying summation on both sides, you got the first equation. Okay. Then Second equation, what you do is, how to get second equation is, to this y is equal to a plus bx1 plus cx2, multiply with x1 on both sides. I have written clearly here. So x1y, then let the summation be same. Only difference is to this one what we are doing, x1 we are multiplying with both sides here. Okay, so summation of x1y, then a summation x, then x1 into x1 square, then c into x1 into x2. So both sides what we are doing is, we are multiplying with x1, summation as well as x1. Remember that. That is how we got a second equation. First equation by taking summation on both sides, then second equation is summation, then even x1. Multiplying both sides, you will get this equation. And third equation, how do you get is, by multiplying with x2 to this equation, first equation only, y is equal to a plus bx1 plus cx2, to that only again what you do is, multiply with x2 with summation again. So summation x2y, so what you will get, summation x2y is equal to a summation x2 plus b summation x1 into x2, this equation, plus c summation x2 square. So this is how you get the third equation. So now what you have to do is, listen to me carefully. Once you take these three equations, so naturally what we require now? Three equations you have taken. Now we require these values, because to get the equations we require which values now? Summation of x1, summation of x2, x1 square, x1 into x, summation of x1 into x2, then summation of x2 square. All this we require or not? So we prepare a table to get all these values, then substitute in these equations, you will get three equations. So what you have to do is, since you have three equations, first you solve 1 to 2, 1 and 2 you solve, then you get one more equation, take it as 3. Okay, not 3, 4 you can take, because already we have three equations, 4. Then next is solve 2 and 3, you will get 5. So solve 1 and 2 get 4, solve 2 and 3 to get 5. So we got 4 and 5 equations. Now what you do, solve 4 and 5. Then solve 4 and 5 to get ABC. So this is what you need to do, my dear students, in case of multiple linear relationship. What is the equation? Y is equal to a plus bx1 plus cx2. So in this, in order to find out a, b, c, we use three equations, supernormal equations. So once you substitute in those equations, you will get, you can solve 1, 2, then 2, 3, then you get two equations now by solving 1, 2 and 2, 3. Again solve those two equations, then you can arrive at ABC. Then you can set out the equation y is equal to a plus bx1 plus cx2. Then you can forecast the values. So this is y on x type. Similarly, x on y type also you can prepare. So use this one. This is a simple one. Even though it is little time taking, but you can be confident of your answer. That is the advantage. So these three equations you have to set out. So let's take one question here from CMA material. See here what is given. In order to find out the effect of educational qualification and experience on the earnings of the workers of CNC machine shop. So here they are trying to draw the relationship between salary and educational qualification and experience. So for that they have taken the past data of 10 workers. A study has been conducted on 10 workers and the data set below is provided to you. So 10 workers data is given and their education is given, experience is also given. So they have given education 11th standard, 12th standard, first year bachelor, second year bachelor, second year, first year masters. The thing is, this should be given in figures, no. Yes, experience is given again in terms of figures. Salary is also given here. Now, conduct a multiple regression analysis. Conduct a multiple regression analysis considering the following numerical equivalents for educational qualification. So, educational qualification 11th stand means we should take numericals now for that. So, they have given those numericals. So, education qualification 11th standard take 11, 12th standard means 12. First year bachelor's means you take 13, second year means 14. Okay, and master's first year means 16. Master's first year means 16. This is the number what we should take. Also interpret the meanings of coefficients of variables and constant terms. So we should also interpret, we should also write the meaning of A, B and C. Those three meanings also we should write here. Right. So first what we need to do is, what is the equation now? Equation is, since we have a 3 here, what is the relationship we need to draw? What is the relationship between education and experience with respect to salary here? So y is equal to a plus bx1 plus cx2. That is the equation we need to get. For that we require 3 equations. What are those 3 equations? These are the 3 equations to get the ABC values. Summation of y is equal to na plus b summation x1 plus c summation x2. How we get this one? By taking summation on both sides for this equation. How do you get second equation? By multiplying with x1 on both sides. X1 on both sides with this equation. What you do is, to first equation multiply with x1 on both sides. Then how do you get third equation? To the first equation multiply with x2. Okay, so remember that. Then we prepare a table to find out this x1 summation of x1 x2 summation of x2 square. So here what is y and what is x1 x2 here? Here educational qualification and experience we treat it as x1 and x2, whereas salary is our y value. Okay, see here, salary is y, x1 represents your educational qualification, x2 represents your experience. Then take these columns, x1 into y, x2 into y we require, x1 square we require, x2 square also we require, x1 into x2. Get all these values and summation, then substitute in those equations, 3 equations. These are the equations you are getting. Equation 1, 2, 3, then solve 1, 2, then to get 4. You can see here 1, 2, equation 1 and 2 here. What we have to do is we have to cancel out one figure now. So we have to see by multiplying with which figure or dividing with which figure we can cancel out one. We see first equation and second equation here. What we have done? Multiply equation 1 with 13.5 both sides. So why I have done that here? To cancel this 135a. 135a we have now here. So this 10. So what I have to do is compare 135 and 10. So what should happen is this 10 should become what? 135. Or this 135 should become 10. Anything you can do. So here what we have done is we have multiplied with 13.5 because this 10 has to become 135. Now it can become 135 is by 135, 10 has to become 135. So how it can become 135? So x is equal to 135 divided by 10. So 13.5 you have to multiply with both sides. So then we subtracted, we got this equation. We only with b and c because we have 3. First we have cancelled one variable. Now we left with b and c variable. So this has become equation number 4 by solving 1 and 2. Similarly by solving 2 and 3. Again one more we cancel, 130 a we cancel, now we left with b and c variables. This will become equation number 5. I will be sharing this PDF. Okay, you can solve it, you can check. So now after that what we do is again we solve equation 4 and 5. Then we will get ABC values. and substitute that in regression equation. So this is your regression equation. So we got A value minus 13,679.78 and B value 2,971.81, C value also 821.923. Yes. So this is your regression equation. So based on x1 and x2 values, we will get y value. Based on x1 and x2, we will get y value. So here we need to even write the meaning of A, B, C. So A is nothing but your intercept. So how to interpret this? When your x1 and x2 is equal to 0, x1 and x2 is equal to 0, then what is your salary? What is the value of y? So salary when educational qualification and experience is 0. Salary when educational. So how to interpret A is intercept. What is your salary when educational qualification and experience is 0? So when x1, x2 is 0, then what is the value of A? That is salary. What is the value of y, that is? Okay, next. What is B here? B represents slope, no? B represents slope. That is, what is a change in salary? Change in salary due to change in educational qualification by 1 unit. Change in salary due to change in educational qualification by 1 unit. And what about C? C is also a slope here. Two slopes we have, B and C. But this one is change in salary due to change in experience by what? 1 unit. So when you A is x1, x2 is equal to 0, then what is the value of y? B is nothing but the slope. So that is, what is the change in salary y value when there is a change in x1? What is C? This is change in y value with respect to change in x2 by 1 unit. Alright, that is the interpretation. Now, if you see one more question now, this next question, here what they asked, this is also your CMA material question only. In this what they asked is, here, the CNC machine shop mentioned in the problem above is going to bid for a, now we are going to forecast what is going to be the salary, because we got the equation or regression line equation. So in this question they have asked to forecast those values. See here carefully, the CNC machine shop mentioned in the problem above is going to bid for a few CNC machine shop only, no, this one question, in this question CNC machine shop. So I will be sharing this PDF, my dear students. In part 1 I did not share. So in part 2 I am sharing. So part 1, part 2 entire notes you will find in this. So this if you do, definitely you are going to get either 7 or 9 marks, including MCQ also. No doubt about it. The CNC machine shop mentioned in problem above is going to bid for few very critical machining items required for nuclear power project. So now they are bidding for a nuclear power project for which they require machining items. For that they have to recruit a dedicated programmer for the machines to operate the machines. Okay, you require a programmer for the machines. One programmer is required for machines. Besides, they need to procure 2 new CNC vertical machining centers. 2 new CNC vertical machining centers which have to be operated by qualified operators. So 2 CNC vertical machining centers you require. 2 new CNC vertical machining centers which have to be operated by qualified operators only. So 2 operators are required. The profile they are looking for the programmer is, so graduate engineer with 5 years of experience. So programmer should have this qualification. He must be a graduate engineer with how many years of experience? 5 years of experience. And operator should have a degree of second year bachelor degree holder with 8 years of working experience. So now they have given you, basically these are what? X1 and X2 values. These are X1 and X2 values. So based on that we should calculate what? See here. If 1000 numbers of critical items are to be supplied within a period of 3 years, how many items they have to supply? 1000 numbers. Then how much extra the company should bid for each item to accommodate the recruitment of a programmer and 2 operators. Now when you are bidding, entire cost you will consider or not? Now if you are bidding for this 1000 units, you require 2 programmers, 2 operators and 1 programmer. So naturally what will happen is your cost will increase or not. So that extra cost you should consider when you are presenting the bid. So what we need to do here is we need to calculate what is that extra cost. Extra cost is nothing but extra salary for those 2 guys, programmer, mission operators. So whatever we need to pay for them, that is only the extra cost. How much extra the company should bid for each item to accommodate each item? Since they are asking each item, first you take total extra cost divided by 1000. If you do, then you will get for each item of a programmer and 2 operators. Use the data set of previous illustration. So we are using previous illustration equation only, no regression equation. Assume educational qualification of the graduate engineer is 20. Since they have given educational qualification but numericals are not given, no. So assume educational qualification of graduate engineer is equal to 20 and that of an operator with second year bachelor degree is 14. Right? So graduate engineer 20. What is 20 here? X1 value. Basically what is that? Experience. This is degree. Graduate engineer degree this is. Experience how many years? That is different. That figure already you know. So this number is for degree. So for graduate engineer what is the figure? 20, and for operator bachelor's degree it is 14 numerical value. So with these values x1 and x2 values here, we need to forecast y, nothing but extra salary. So solution to this is, now programmer should have educational qualification graduate engineer and operator should have second degree, and what is the number they have given? 14. So x1 20, 14, and experience is treated as x2. 5 years for programmer, operator 8 years. So now how to get salary of the programmer first? Each one you can get separately. First programmer and then operator. So salary of programmer, now here what are the x1 and x2 values? X1 is educational qualification, x2 is the experience. What is the educational qualification? 20 x1. Experience is 5 x2. So substitute in this equation, regression equation, x1 and x2. For programmer we got now what is the monthly salary? 49,866, because that regression equation is monthly only. So 49,866 per month for recruiting this programmer, one single programmer. Now similarly, for if you recruit one operator, then what will be your extra salary will be? Take the equation, take x1 and x2. For operator, what is the x1? Nothing but the educational qualification figure 14, and x2 represents the experience 8. So substitute in x1, x2 14, 8. You are getting 34,500 per month for one operator. One operator. So now what you need to do is, how many operators are required? 2 operators over a period of how many years? 3 years. That is what given in the question. You can see clearly. And over a period of 3 years, how many units you are going to? If 1000 number of critical items are to be supplied within a period of 3 years. So what we need to do is, we need to calculate what is the total cost of the salary for this 1000 units over a period of 3 years only. 1000 is for 3 years only. So now 1 month we know what is the salary of programmer, 49,866. For 3 years how much it will be? 49,866 into 12, 1 year, into 3 years. Similarly, programmer you have 2, 35,500 per month into 12, 1 year per person, into 2 persons, into 3 years. So this is the total salary for 3 years. So both if you add now, 42 lakhs 79,176 is the total salary cost, extra cost for making 1000 critical items over a period of 3 years. So now we are bidding per unit now. So what we need to do is divide it by 1000. Since they asked for each item, so divide by 1000, you are getting 4279.176. So this is the extra cost which you should consider for bidding purpose. Understood, students? This is your multiple regression questions. 2 questions we have done for that. I hope you can practice this. So that was multiple linear regression, students. So multiple regression case, we are trying to draw a relationship between one variable with many variables. Okay. How to get A, B, C through 3 equations, then substitute in the regression line. Now we'll move to next one, time series, students. So what is time series is when you draw the relationship between time and any other variable. If you remember earlier, between 2 variables, but in time one of the variable is time. So whenever you draw a relationship between time is taken as x and any other variable y is called as time series. Time series is very, very important, my dear students. Alright, because in real life also we have many advantages with time series. So that is the reason they have been covering mostly in the examination from time series only. Probably this time also they might cover from time series only. So watch till the end because I am going to cover all the methods. As you all know from my previous videos, I have been covering exhaustively everything, right? So I hope it will help you out, because no one wants to lose easy marks. And as I told you earlier, if you want to pass or get exemption in SCM, first you should bank on QT topics, right? Then you can bank on your costing portion. So especially business forecasting is a easy chapter, right? So some steps are involved, just remember those steps with some logic, then easily you can score in this particular topic. So time series is here when you try to draw the relationship between time and any other variable, we call that as time series. In this, time is the independent variable. Here time is the independent variable. Okay, time can be yearly, monthly or quarterly here. Okay, and dependent variable could be sales, so exports, profits. So the relationship between time with sales, time with exports, time with profits. So this relationship, that is what we are trying to understand here. So in order to, now if you want to know what is the difference between regression and time series, what is the difference? In regression, we were trying to draw a relationship between any 2 variables. Okay, it was a casual relationship. It was a casual relationship. Whereas in time series, we are trying to draw the relationship between time and any other variable. This relationship can be now, concentrate now, we are moving into the important part. That is, now this relationship between this time and other variables can be broken into different components by the statisticians. So what are those different components in your relationship, that is in time series, is these are the components. Once again I am repeating. So whenever you are trying to draw the relationship between time and any other variable, okay, that relationship is broken into several components. That means we have multiple effects in that relationship. What are those multiple effects or multiple components are? These are the 4 components. First one is trend. The first component in time series is trend. So very important, this trend. What is the meaning of trend is, trend shows what is the pattern, that is either the increase. See, trend means either increase or decrease. Trend means what? Either increase or decrease over a period of time. So over a period of time, it will show you either increase or decrease. So say for example, now we have used a line diagram now, and your line was like this. So that means you can see clearly this is a line representing the trend. So this means clearly we can understand that it is going up. With the time, as the time progressing here, probably your sales is what? Increasing, or profit is increasing. So this increase, clearly you can see that it is an increasing trend. Similarly, we can also have decreasing also, no? Yes, so that is also a trend, like this. So what is trend is? Trend is nothing but it shows the changes, that is increase or decrease over a period. That period could be 1 year. So over the years, what is the change that has happened, either increase or decrease? Remember only these two, either increase or decrease. That only we call it as trend, increasing trend or decreasing trend. So when you have sideways like this, sideways movements, this is not, there is no trend at all. You cannot see any trend here, right? So whenever you have sideways movement, there is no trend. So only rising and falling. So this is the first component in your time series, that is trend. So trend is measured generally over the years. Remember that. If you want to know the trend, generally you should take a number of years to find out. Say minimum 5 to 6 years you have to consider to know the trend. Otherwise you cannot know what is the trend. Second component in your time series analysis is seasonal variations. Seasonal variations means the variations due to seasons or the variations due to festivals. Alright, due to seasons or festivals, whatever variations you see in the variable, either sales, profits, that is called as seasonal variation. So generally this is within a year. Within a year we get seasonal variations. So over the months or quarters in a year, we try to get the seasonal variations. So what is seasonal variations? The effect on the variable, either sales or profit, due to seasonal effects. So this is second one. So we have to measure this also. So this is measured generally. What is the time period? Over months or quarters in a year. Trend generally over the years, whereas seasonal variations generally months or quarters we take within an year. Third one is cyclical variations. So due to recession, boom, recession and boom, whatever variations we get, that we call it as cyclical variations. So generally this we will have over number of years. So if your recession is going on, probably it might stay for 2 to 3 years. Or if there is a boom, that also will stay for some years. So over the years, boom or recession. So whenever you see only a rising trend there, that is, and that is remaining stagnant. So we can say that that is the, which one? Cyclical variation. So we will have this variation over the cycles. Different cycles here. Cycles, in my product life cycle, I think you all know it. So over the cycles, we will see these variations. So generally boom, recession, we call those as cyclical variations. So this is the third component. And fourth one is irregular or erratic variations. Irregular erratic variations means these are unexpected, due to unexpected events or abnormal situations, whatever variance we get between our actual and expected, that is only called as irregular or erratic variations. Like war, tsunami, earthquake, right, fire accident. So all these are unexpected things. No, so due to unexpected thing, whatever you get variation, that is called as irregular or erratic variations. So these are the four components in your time series. First one is trend, second one is seasonal variation, third one is cyclical variation, fourth one is irregular or erratic variation. So in this our syllabus, they have given to measure the trend and seasonal variations, they have given various methods. So mostly they have been covering from these two only. Cyclical variations, they have not given those. Of course, irregular or erratic variations, by comparing actual with the forecasted, we get those. But cyclical variations, they have not given what are the methods. We have methods, but those have been not given in your syllabus. So focus on seasonal variations and trend. How to calculate the trend and seasonal variations. So this is what you need to understand in case of time series analysis. First, we will focus on how to calculate trend in time series and what are the methods we have. So, we have three methods to calculate this trend. And one more very important thing is, whenever you are trying to calculate this trend or seasonal variations, we have two models in time series. One is multiplicative model, other one is additive model. What is the first one? Multiplicative model. This is the first model. The other one is additive model. Generally, we use multiplicative only, but question sometimes requires this also. So, depending on which one you have to use, what is given in the question. Additive model we can use, or multiplicative model also we can use in time series. That means to get the forecasted values, we can use either multiplicative model or additive model. I told you that there are four components in your time series now: trend, seasonal variation, cyclical variations, and erratic or irregular. So this is multiplicative, where we multiply all the components to get the forecasted value. Whereas in additive model, what we do is we add them to get the forecasted values. Right? So in additive model we will add, and in multiplicative model we will multiply all those four components to get the forecasted values. In our studies, we have methods to calculate or determine trend, seasonal variations and cyclical variations, and I value is determined by comparing actual value with forecasted value. How do you get your I value, that is erratic, is by comparing actual with forecasted values. That is how we get. So let us study these models now. For measuring, first one will start with trend. So to measure the trend now, we have three methods. Method of least squares. First one is method of least square, nothing but your regression method only. Second one is moving averages. Third one is exponential smoothing method. And so far they have covered first one and second one. This one. In examination they have covered. Method of least square they have covered, and exponential smoothing method they have covered. These two they have covered. So naturally very important will be first one and third one. Okay. Right. Now let us cover first one, method of least square or regression method. As you all know, friends, regression equation is y is equal to a plus bx. You remember that? Yes. So this method you might find it very easy. So method of least square is, in this, depending on which type of equation, whether it is straight line trend, whether you have straight line trend or you have a parabolic trend. So depending on that we take the equation here. Method of least squares. So type 1 is straight line trend. If you have straight line trend, then what is the equation? Y is equal to a plus bx. This is nothing but your simple linear regression only. Okay. So but the difference between here in time series and there in regression is, what is the difference here is, here x value, y value, there is a difference. So here what is x and what is y here? X is our time. Here x is our time here. Okay, so time, when you are plotting, there is a difference how we plot the time. Earlier both are variables only, but here one of the variable is time. So when you are plotting time, how do you do it? That is very, very important. That is a new thing you have to learn here. That is the only new thing. You know that straight line trend means it is like simple linear regression only. Y is equal to a plus bx. So what is a? A is the intercept. That is y value when x is equal to 0. B represents what? Slope. That is, what is the rate of change in y with respect to change in x. That you know. Now only new thing is, y is any variable. Other variable whatever is given in the question. X represents what? Time. So this you should take properly. x value and y value you should take properly here. How to take x value is small x minus origin divided by scale. Remember this formula. This one is important. X minus small x minus origin divided by scale. So how we should do this? How to get this? Which one we will take it as origin? That depends on the data given. Okay, whether it is even data or odd data. So you need to concentrate here. So how to determine this origin and scale is very important. That is what you should learn here. New thing. So that depends on whether n is equal to odd number of years or even number of years. So see how to select the origin and set the scale here. First case, if you see here, n I have taken odd number of years. You can see 1, 2, 3, 4, 5. 5 years you have, so odd number. And here we are taking as y, sales x, data. Now, since you have odd now, what is the origin here is, you can take middle year as the origin. Origin is nothing but what? The average. When you are plotting in the graph, when you are plotting in the graph, the years, you should take from origin only, no? Time. Time you need to plot. So whenever you are plotting time, you require origin or not? Yes. So that is the difference in regression equations and here in trend. Since here one of the variable is time, whenever you have time, always we need to find the origin. That depends on the data here, number of years. So which one we can take it as origin here is exactly 2012 we can take it as the origin here because it is falling between 2 years. So how it will be represented here, you can see here on the graph. So this is the origin. Now remaining 2011, 2010, 2013 and 2014, 15. Right hand side, left hand side. Right hand side positive, left hand side negative. Remember that. So now how do you take this origin is depending on n value. So if n is equal to odd number of years, then the middle value only will take it as the origin. So middle year you will take it as the origin here, 2012. And now from 2012 to 2013, exactly one year gap you have or not. So you can scale, you can take it as 1 year. Scale you can take it as 1 year. So now how do I calculate now x value for 2012? 2012 x value is 2012 minus origin is also 2012 divided by scale is 1 year. So exactly you are getting what? 0. So always the origin will have here in this, especially in this case, you will have 0. Okay. Then 2013 minus origin is 2012 divided by 1 year. So 13 minus 12 means 1 year. 1 divided by 1, 1. Positive 1. 2014 positive 2. 2011 minus 1. 2010 minus 2. So that the sum of this will be equal to what? 0. The sum of this is equal to 0. Because when x is equal to 0, we have to find out what is a y-er intercept. Yes. So, and our objective is method of least square. The method of least square. Why they have given that name here is, now when you plot the values, which values? The y values here, that is variable values here. These are the plotted values. This one, this one, this one, this one, this one, this one. Now what we are trying to do is, we are trying to draw a line which is nothing but the average of all these or not? Yes. Now the difference between these values and the plotted values we are trying to minimize. Our objective is how we minimize the difference between our average values and our actual values. So that is the reason we call this as a method of least square. So our objective is to minimize this the difference between y and y bar. Y bar is nothing but what? Average. So our objective is to minimize this. So this is only called as line of best fit. Y is equal to a plus bx is called as the line of best fit. So our objective is what? To minimize this difference. Which difference? The difference between y and y bar. Y bar represents what? The average. Whatever is on this line. Y represents the actual values. So we are trying to differentiate. So if you want to minimize this, which is we call it as line of best fit, this is the equation. Y is equal to a plus bx. Right? So I hope you understood how to calculate x value with respect to odd number of years. If you have even number of years, then see here 1, 2, 3, 4. We have 4 years. So what we need to do is, in this case, these 2 years we should take it as the origin. 11 and 12 we should take it as the average of these 2 years. So average of middle years. 2011 plus 12 divided by 2, you are getting 2011.5. So what is the average here? 2011.5. So if you want to take now, what is the x value? So 2011 is the origin. From origin, if you just remember the graph, origin is 2011.5. So 2011 means exactly how much? 2011, then 2012, then 2013, 2010 means, how do you get the x value now? This is origin 0. Okay, from here 2012 means 0.5. This one is 1.5. What about 2011? Minus 0.5. Here you can take minus 1.5. So ultimately the sum will be equal to what? 0. Right? In this manner you can take, or what else you can do is, if you take directly scale as 0.5 years, since because the difference is 0.5 years only, no. So if you take 0.5 years, 6 months, then what we can do is, we can calculate x value. How we can calculate x value? How much you will get x value now? X minus origin divided by 0.5 years we are taking now. So if you calculate for 2011, what will be the x value? 2011 minus origin is 2011.5 divided by 0.5. So minus 0.5 divided by 0.5, exactly minus 1 only you will get. What you will get? Minus 1. For 2012, what you will get? Plus 1 you will get. You will get plus 1. So that is how you should take x values. So once again I am repeating, students, whenever they ask you to find out a trend, using a method of least squares, the first thing is, what is the equation? The line of best fit, what we call it as, is y is equal to a plus bx. In this, you know what is a and what is b. A is the intercept, that is the value of y when x is equal to 0, and what is b also, you know, that is slope. Here one important thing is, we know what is y. Y is the variable, but x time, how do you represent in x axis? That is most important, right? For that only this explanation whatever I have given is very, very important, because when you are trying to plot on x axis, origin also you should consider. Whenever you are plotting time, first you should determine origin, then based on origin only I can plot. Otherwise, how do you plot the years? What is the scale you will take for years, right? This you might have done in your intermediate also. So I don't think you will find any difficulty in getting these x values. So depends on odd number. Odd number if you get, then the middle year only you can take it as the origin, then you can calculate x. But in case of even number, then you should take origin is equal to average of middle years. Scale you should take 0.5 years, that is 6 months. So here we try to understand what is the meaning of method, why method of least square they have given. We are trying to minimize. What is that minimizing line? Which minimizing line? The difference minimizing line. The difference between actual values and average values. Our objective is to minimize that, least one. So that is the logic behind that. Next one is, if you get parabolic trend like this, not a straight line. If you get parabolic, then your equation should be this one. Y is equal to a plus bx plus cx square. This is the line of best fit. When it is a parabolic line, then you should use this equation, not a straight line. This is parabolic line equation. This is straight line equation. Understood, my dear students? So this is almost equal to simple linear regression only. Only thing is, x value, how do you calculate? That is what most important here. And when you have parabolic a plus bx plus cx square, you have to use equations again to get a value, b value and c value. So type 2 is quadratic trend. X square you get quadratic trend. So here also same. How to get x value? X minus origin divided by scale. Now, but only thing is, but to get a value and b value, c value, we have to take the normal equations. These are the normal equations. Do you remember? Simple linear regression also we used. So same equations you should use. Students, here this one is for straight line, a value, b value. Okay. Two equations you will have, and if you have ABC, three variables, then you have three equations now. These are three equations already in multiple linear regression I gave you. Same equations to get ABC values. Okay. So I hope you understood method of least squares for measuring the trend in time series. So it is almost similar to simple linear regression only. Only new thing is x value, that is time. How do we represent in our graph? Even in table also, how we should determine the x value depends on whether we have even number of years or odd number of years. Right? So let us take one question. This is a past exam question. The following relates to tourist arrivals in India during 1990 to 96. So they have given years and tourist arrivals. So how many years? First of all, they have given 1, 2, 3, 4, 5, 6, 7 years they have given, odd number only. Fit a straight line trend. So clearly given here, fit a straight line trend. So trend means you can understand that the moment you see years, you can see that, you can understand that it is from time series. Okay, what we have to forecast is tourist arrivals. And for this, to draw the relationship between time and this tourist arrivals, you have to draw a straight line, line of best fit by method of least squares. Using which one? Method of least squares. And estimate the number of tourists that would arrive in the year 2000. 97, 98, 99, 2000. So 2000 year we have to determine what is the number of tourists. That depends on the x value. Now, once you give the x value, then automatically we can get for even 2000 also. So, which one is the origin here? I told you that origin is very, very important here. Here, n is equal to number of years is 7 years. So, middlemost year, what is the middlemost year here? So, 1993 is the middlemost year. So, what is the straight line trend equation? Y is equal to a plus bx. Okay, here what is y? The forecasted value of tourists, and capital Y, this is small y, represents the actual value of tourists. You all already know this. Small x represents time in years. So capital X represents this also represents what? Forecasted time, future time. This is actual time. No, this is forecasted time. How do you get forecasted time? That is very important. That is what we have learned so far. So as number n is equal to 7, odd number, origin is middle year, that is 1993. So we can take scale 1 year. So now we know that two equations we have to use to get value of A and B? What are those two equations? Summation of y is equal to NA plus B summation X. So, and another one is summation XY. So, to get those two equations, this one summation y and summation XY, NA plus B summation X, summation XY is equal to A summation X plus B summation X square. To get summation X, summation Y, summation XY, X square, we have to prepare a table. So, Y is your tourist, X represents the actual time, capital X represents the future time. Okay. XY we require and even X square also we require. Now we took 1993 as the middlemost year in origin. So origin, if you calculate, X is equal to 99, X is 1993 minus origin is also 1993 divided by 1, you will get 0. And from 1993 to 1992, remember the graph, back left side, no, left side means minus you will get. So from here to here minus 1. So you have to calculate using that X is equal to, capital X is equal to small x minus origin. So 1992, how do you get? X is 1992 minus origin is 93 divided by 1. So you will get minus 1 divided by 1 minus 1. Then 91 minus 93 divided by 1. So minus 2 divided by 1 minus 2. So this is how we are calculating X. Now like this from 1996 to 2000, if you want, 2000 means 96 is 3 here from origin. Then 97 4, 97 4, 98 5, 99 6, 2007. So for 7 we have to calculate Y value, forecasted value. Later on we will do it. For that we have to first calculate the equation. No, first we should set the equation. So summation X square value also we have now, all the values. Now only thing is to solve for A and B. Substitute in these equations. Summation of Y is equal to 168 is equal to NA, number of observations is 7, A plus B summation X. I told you now students how to get this Y is equal to A plus BX. So both sides you add summation. Summation Y, summation of A is equal to NA plus B summation X. This is the equation you will get. So already you know summation X from above, summation Y also you know. So from this only directly we are getting A is equal to 24. A is equal to 24 you got, and substituting that in this equation you automatically will get B also, which is 1.893. So we are able to set the equation of Y is equal to A plus BX. Substitute A value and B value. Y is equal to 24 plus B is 53 by 28x. Now for year 2000 they asked you to calculate the tourist arrivals. No, year 2000. So year 2000 means just now I was telling what is the X value? 7. So number of tourists for the year 2000 is X is equal to capital X, that is capital X represents the future time. So 2000 minus 93 means 7 divided by 1, 7 years. So substitute in this equation, Y is equal to 24 plus 53 by 28 into 7. So you are getting 37.2 lakhs, 25 lakhs. That is the number of tourists expected in the year 2000. Number of tourists expected in the year 2000 is 37.25 lakhs. I hope you understood this, students. So already they have asked in examination once. So probably again you can expect this easy one. So this is the first one for measuring trend, that is line of best fit. So here we use a straight line. We might have even parabolic also, quadratic trend. Right. Let us take one more question for that. Of course, you might say, sir, you have done for odd number of years. Now, what about even number of years? If you have even number of years, then how to calculate X value? I told you, you should take scale 0.5 years. See this now. So even question is also set on the left hand side. You can refer to the question and then answer also. From the following past data of sales in lakhs of rupees of a company, estimate the same for the year 2005. So how many years you have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 you have. So 10 means again even number. So two middlemost years here we should take. What are those? 94 and 95. left hand side, right hand side, equal number of years you have. So average of these two. Origin is average of 94 plus 95 divided by 2 you should take. Assume the trend line to be linear. Trend line to be linear. What is the monthly rate of increase of sales? So if you see here, what is the data they have given? Sales is one variable, other one is time. So we have to estimate what is the monthly rate of increase of sales. Rate of increase of sales. So how do you calculate the rate of increase of sales? Nothing but change in sales, nothing but B. B we have to calculate. Okay. So first the trend line equation, y is equal to a plus bx, where y is equal to forecasted sales, small y is equal to actual sales, small x is equal to time in years. Now since n is equal to 0 here, it is even number, so origin is equal to average of two middle years, 94, 95 divided by 2, 1994.5, and what would be the scale? You should take 0.5 years. Why it is 0.5 also earlier I explained you. From 1994.5 to next 1995 means in the graph it is 0.5 only, no? So take 0.5 only so that you can avoid that fraction. Okay, so set out the data y, x, capital X, xy, x square. Okay, so here I have given the summation of those figures directly. So what are those equations? Y is equal to summation y is equal to na plus b summation x, substitute a is equal to 19.2, b is equal to 0.536. So y is equal to, this is the equation. Okay, and did they ask what is the forecasted? Now if you want to forecast the sales for which year, did they ask? Yeah, they asked in the first part, no? Estimate the same for the year 2005. Before rate of increase of sales, they asked you to estimate for 2005. 2005 means what will be the x value? 2005 minus origin is 1994.5 divided by 0.5. What you will get? 21 you are getting, capital X. So substitute the 21 in the equation. You are getting 30.46 lakhs as sales. This is the forecasted value for 2005. And they asked you to calculate rate of increase in sales. Rate of increase in sales is nothing but your slope only, B. So B is slope, that is rate of change in sales with respect to change in time, which is nothing but 0.536 we got now. But the important thing is, yes, this is for yearly, no. The change is yearly, because every figure here in the question, if you see, yearly increase only in sales, no. But they asked monthly. That is one important point. Okay. Monthly rate of increase in sales, no. Whatever B is, per annum increase that is. So if you want monthly, we should divide it by 12. You should be careful. There is a possibility of missing that. So monthly means we should divide it by 12. So this is the answer. Monthly rate of increase in sales. I hope you understood, students. So this is even case, even number of years. So this is the first one, how to measure trend. So these two are very important these two questions are very important from examination point of view. So we have completed trend, measuring of trend first method. What is the first method? Method of least square. Method of least square. Now we will move to method number 2 is moving average. Moving average. So what is the difference between simple average and moving average is, in simple average, what we do is, we take the average of the existing items. We take the average of what? Current period. Whereas in moving average, and those years also will remain constant. Whereas in moving average, what we do is, our years, the period whatever we are going to consider, will keep on what? Fluctuating. Will keep on fluctuating. So that is the difference between moving average and simple average. So in this moving average also we have simple moving average and weighted moving average. Simple moving average and other one is weighted moving average. See, these all are good concepts. Weighted average, simple average, moving averages. What is the real purpose? Moving averages in stock market they use to understand the pattern I mean to forecast the movement of the share price, we use moving averages. So here in this moving averages, to measure the trend, here we are using moving averages. We have two categories. One is simple moving average, the other one is weighted moving average. In weighted moving average, we consider weights also. We give weights to the years, whereas in simple moving average, we do not give any weights. When you are doing simple moving average or weighted moving average also, the data, the number of years, whether it is odd or even, it matters when you are doing moving averages. Whether they have given odd period or even. If they have given odd period, well and good. Okay, but even if they give you, okay, it is little time taking. Most of the students will find little difficulty in understanding even number case. Okay, it is not difficult at all, it is easy only. Odd number is easier than this one. So in simple moving average or weighted also, what you have to see is whether odd number of years are given or even number of years are given. Accordingly, okay, our procedure will change slightly. Now let us first understand the odd number of periods average. Take this example here. Time is given years 2010 to 16 and one variable is sales. So we have to draw the relationship between these two. Using we need to measure the trend in sales with respect to time using moving averages. So find 3 yearly moving average, 4 yearly moving average, 3 yearly weighted moving average with weights of 1 to 1. So what are the weights for 3 yearly weighted moving average? What are the weights we should consider for those 3 years? 3 years figures, whatever we take, 1 to 1. So first one is 3 yearly moving average. So how many 3 yearly moving averages we can calculate now from 2010 to 16? How to calculate these moving averages? I told you no. This is simple moving average only. Whether odd number of years are given or even number of years are given. Now, how many 3 yearly moving averages we can consider? See here. First, 2010, 11, 12, 1. Okay. Next, 11, 12, 13, 2. 12, 13, 14, 3. 13, 14, 15, 4. 14, 15, 16, 5. So 5 3 yearly moving averages we can get. How many we can get? 5. So how to calculate those? Watch this carefully. How many observations are there? Yes, 7 observations are there. 7. 1, 2, 3, 4, 5, 6, 7. How many averages we can calculate? Just now I told you 5 averages we can calculate. We can calculate 5 3 yearly moving averages we can calculate. So if I want to calculate the first moving average, 2010, 11, 12. If I take the average of these three, the question what comes to our mind is corresponding to which year I need to show that average. So average means naturally in the middle year only we should show that corresponding to middle year. That means 2010, 11, 12 moving average I need to show corresponding to what? 11. Are you getting? Yes. So that means we will have 2 blanks. You know where we will have those blanks? 2010 we will have a blank and even 2016 also we will have a blank. If you want you can check. So I am going to leave out first one. 2010 we will not take any moving average we are not taking, no. We are taking 2010, 11, 12 I am taking these 3 and where I need to present that average exactly middle year, that is 2011 because it is 3 yearly, no. 3 yearly. 4 yearly means there is a problem again, even number, no. Yes, first you learn this 3 yearly. So against 11 I can show again 11, 12, 13 when I take I can show corresponding to 12 I can show that. Similarly 12, 13, 14 when I do moving average I can show corresponding to 13 that moving average. Next when I do 14, 15, 16 corresponding to 15 I will show the moving average. That means 16 will not have moving average. Even against 10 also will not have any moving average. So whenever you are using moving average, the limitation is we will, for some years we will not have moving averages. That is a problem. And if this moving average time span is more, you will get more like this. If you take 4, you will get 2 and 2 blanks above, 2 blanks below. Right, that is the limitation of moving average. So here, how to know how many blanks we will have is, take number of observations, then take number of moving averages you can calculate. The difference between those two only 2. So if this 2 is even number, if this 2, this number is even, if you get, then there is no problem. If you get odd only, there is a problem here. Why that is, I told you already. Okay. Now, let us calculate the 3-yearly moving average. So 2010 sales is there, corresponding this I cannot take any moving average. Why? Because 3-yearly means 10, 11, 12. And against which one I can show? Average means I can show middle. So yes, corresponding to 2011 we can show. So first you take 3-yearly moving total, 20, 30 plus 40. Then how do you get average divided by 3 years? 30. So this 30 is the forecasted value which should be shown corresponding to which year? 2011. That is the middle year. For 3 years, that is the middle year. Next again 11, 12, 13, if you calculate moving average. Okay. 10, 11, 12, where I need to show? Against 11. When I calculate again, now leave out 10. Moving, no, 1 year over next. 11, 12, 13, when you calculate, you will show again corresponding to 12. So 11, 12, 13, 30, 40, 15, total is 120. 3-yearly moving total first you should take. Then you should take 3-yearly moving average. How do you get 3-yearly moving average? This total divided by 3. Next, 12, 13, 14 moving average, 3 years. 40, 50, 55. So 145 divided by 3 if you take. Then corresponding to which one? Middle one. So similarly, 14, 15, 16 if I do again, you will get a corresponding to 13, corresponding to 15 also you will get, because 14, 15, 16 last moving average if you calculate, 55, 65 and 80, 200, that corresponding to which one I can take only? Against 15. That means this one will be blank. Are you getting, my dear students? So it is very simple. 3-yearly moving average is very, very simple here. First you should take 3-yearly moving total. Remember, take the totals of the sales here. Don't take totals of the time. Anyhow, you cannot take that. So sales, you can take the totals and then take the average. When you are taking the average divided by number of years of moving average, 3 they asked, so divide by 3 only. So it was quite comfortable. Next, problem is when they give you 4 even case. 4-yearly moving average. Concentrate everyone here. 4-yearly moving average. Tell me how many 4-yearly moving average you can calculate here. 4 years. Four-yearly, how many you will get here? 10, 11, 12, 13, 1. 11, 12, 13, 14, 2. 12, 13, 14, 15, 3. 13, 14, 15, 16. So 4 only you can calculate. Number of observations 7, but number of moving average will get only 4. That means 3 blanks we will have or not? Yes. Next problem is, concentrate. When I calculate the 4 years moving average, 10, 11, 12, 13 I take. And where I should take that average, corresponding to which year I need to show that average 4-yearly moving average? Because we don't have middle year now. So that is the reason what we do is, see what we have done. To counter this only, we have a problem here because we got odd number, 3. There is a problem now. We got odd number, the difference. So that is the reason, to counter that only what we do is, see here how we have taken this. 2010, 11, 12, 13, 14, 15, 16. If you observe carefully, I left space between 2010 and 11, 11, 12 also. The reason for that is, I will take in the middle. That means 2010, 11, 12, 13 moving average I will take exactly between 2010 and 11 here. Next, why I am taking in the middle here? The reason for that is we got 4 yearly. If you want, can I show again corresponding to 11? I cannot show. That is not the middle year, no, average year, no. So that is the reason to counter this problem. Only what we do is ultimately we have to. Now you may ask, sir, you are trying to show that average. I did not say average here. I just asked you to take 4 yearly moving total. Just what you take is 4 yearly moving totals you take first. So 2010, concentrate everyone. 2010, 11, 12, 13. These are the 4 years now. This 4 years total 20, 30, 40, 50. How much is this? 140. How much is that? 140. This 140 now, actually we should show this in the middle years. But what is the middle year? 11 you have, 12 also you have. So that is the reason what you do is in between these two you should show. In between these two. Between 2011 and 2012 you should show this total. Okay. Similarly next 2011, 12, 13, 14, where I need to show middle means between 2012 and 2013, this one. Got it, students? So whenever you have even number moving averages, first you take the totals, 4 yearly moving totals you take. Now you might have observed, what is the problem you might have observed is, these totals you are not getting exactly corresponding to the years, because when you take corresponding to the years only you will get forecasted values, no? Yes or no? Yes. But I am not getting these totals corresponding to these years. Since we are not getting this corresponding to years, what is the solution for that is, we take 2 yearly centered moving totals. What I will do is, to get exactly corresponding to the years, see now what I am doing is, these totals 140 plus 175. 140 plus 175, the total which we call it as centered moving total. Centered moving total. This, why we are using this is to move the moving total, earlier 4 yearly moving total, to the center. To move it to the center, we are using this centered moving total. Exactly 2 years. Why we require only 2 years? Logically you think now. To move this 140 now, the difference of 140 and 175, now I want corresponding to the years. Isn't it? So that is the reason what we do is, we take 2 yearly, 2 items centered moving total we take. What is the reason for taking this? The reason for taking this is to get the moving averages corresponding to years. It should not fall between the years, no. To get corresponding to years only we are taking this centered. That is the reason the name has been given as centered. To take these figures in the center, to get the moving average in the center, we are taking this centered moving totals. So concentrate here. First, I hope you all understood 4 yearly moving total, that we take in between the years for each one, for each moving total. If you see here, how many moving totals we got here? 1, 2, 3, 4 we got. 4 only we can get now. Now to get this moving average exactly corresponding to any year, we take centered moving total. 2 years centered moving total we will take. Right. Why 2 years only? Why can't be 3 years? Check here. If I take 2 years, then I will get average exactly in between this or not. If I take 3 again, what is the problem? Center again will get in the center only again. In between 2 years only you get. If you take 3 years centered moving total, not corresponding to any. If you take 2 only, then it will fall exactly corresponding to year. So what you do is, take 2 items centered moving total. This one, 2 items means you should take 4 yearly moving total items. So 140 plus 175, exactly it will fall between these two, that is 2012. So 315. Next 175, 210 total. exactly 2013. 210, 250 total, exactly this one. So when you are doing, you will only know that yes, everything is going well. When you go wrong, obviously exactly positioning will not come. So why do we have done this? Why we have taken this 2 items centered moving total to move this averages, to take this average corresponding to the years. So you can see that 315 is falling exactly corresponding to this year. So 315 now, okay. Now divided by which, how many years we should take? Here we have taken 4, to get this we have taken 4, here we have taken 2. So overall 4 into 2, 8 we have to consider here. To get the averages, how many we should take? 8. That is how you will get the 4 yearly centered, we call this as 4 yearly centered moving average. What is that? 4 yearly centered moving average. So 315 divided by 8. So 39.375 is the forecasted value of 2002. That is the 4 yearly centered moving average for which year? 2012. And corresponding to that year you are getting. Next, 48.125 you are getting corresponding to 2013. 57.5 you are getting corresponding to 2014. I hope you understood, students. So only when you get this even number of moving totals, there is a problem. There only you take this centered moving totals. Okay, yes. Other one is weighted average. Second one also we finished. Moving average also, I hope everyone understood why we take this centered moving total. Now third one is 3 yearly weighted moving average. Now this time what is the new thing is weighted. 3 is common to us, no problem. So how many blanks we will get? So total number of observation is 7, and 3 yearly means we will get how many? 5. So 2 blanks we will get above and below here. Okay. The difference is now weighted moving averages. We should also consider weights. So 3 yearly weighted moving total first we should get. 2010, 11, 12, 20, 30, 40 is simple moving average. But what we need to do guys here, we should also multiply with weights. 2, here 1, then take the sum. So that is the reason we are calling it as weighted moving total. What is this? Weighted moving total this is. Then divided by, how do you get 3 yearly weighted moving average? Divided by sum of the weights. What is the sum of the weight? 1 plus 2 plus 1 is 4. 120 divided by 4. It is like weighted average only. Corresponding to this figure only we will get. Again, if you get this 4 yearly weighted moving total, then first you should take 4 yearly moving totals. Then 2 yearly centered moving totals again you should take, so that you can get corresponding to a year. Okay. So only difference between weighted average and simple average, we are also multiplying with weights here to get the total. Then when you are dividing, don't take the number of years for calculating average, take the sum of the weights. Right, students? So I hope you got the conceptual knowledge here to calculate the moving averages. So far they have not asked moving average questions, but they might. Done. So second method also to calculate, to measure the trend, second method also we have finished. What is that? Moving averages. What is the third one? Third one is exponential smoothing method. What is the third method? Let me show you that methods. What are the methods we have? Methods of measuring trend. First one we have finished. That is method of least square. Moving average also we have completed. Third one is exponential smoothing method. Even this is also covered recently. So exponential smoothing method, what we try to do is, we try to smoothen the difference between actual values and forecasted values. Right. So here from examination point of view, just I am covering here, because again it will take some time if I start explaining this. Just understand that here we are trying to smoothen. We are trying to smoothen the difference between actual values and forecasted values. And what is the formula for that is to calculate the forecasted values. See here. Here we use a special coefficient called a smoothing coefficient. This is the formula, exponential smoothing method, everyone. So here under exponential smoothing method, just remember that this is how you calculate the forecasted value, which is represented by T, So how do you get this forecasted value? Is forecasted value of the previous period plus like T minus 1, previous period plus, then what you should do is take the difference between current value and previous forecasted value difference, that you multiply with smoothing coefficient given in the question, which is represented by alpha here. So this is the formula to calculate the forecasted values under exponential smoothing method, that is forecasted value of previous period plus take the difference between current minus previous into multiply with what? Alpha. Now if you simplify this further here, just open up this alpha here. What is this ut means here? Ut is representing the forecasted value here. T minus 1 is nothing but forecasted value of previous period. Alpha represents the correction factor or smoothing coefficient, and yt is the actual value of current period. T minus 1 forecasted value of previous period. Now what you can do is, if you open up this alpha here, multiply with alpha yt minus alpha ut minus 1. Now if you take now ut minus 1 common, you will get 1 minus alpha plus alpha into yt. This is the revised formula you will get to calculate the forecasted values. How did we get this? I opened up this alpha here, alpha into yt, alpha minus alpha into yt minus 1. So mu t minus 1, if you take common, then I will get 1 minus alpha plus alpha yt. So this formula also you can use. Quickly you can finish off the problem. What is that formula here? So forecasted value mu t is equal to mu t minus 1 into 1 minus alpha. T minus 1 is nothing but forecasted value of previous year into 1 minus alpha plus yt represents current year forecasted value, current period forecasted value into alpha. Okay. Yes, this is the formula, shortcut formula, simplified version of that formula. Alright. Let us take one question, students. So remember the formula here. Original formula only you remember, this one. Forecasted value is equal to, which is represented by T, is equal to forecasted value of previous period to the previous forecasted figure. Add, what you should add to that? The difference between actual and actual current period forecasted value and previous period forecasted value into alpha, smoothing coefficient. Remember this is the formula. So let us do one problem on this, because very important from examination point of view. This is the question here. We have two questions on this. This one is the examination question. Second one is the examination question. First one is your material question. Okay, if I explain the first one, automatically you can be in a position to calculate second one also. Messrs BP Leathers, a shoe manufacturer, has a modern outlook and they depend heavily on business forecasting methodology to plan their business activities like manufacturing, marketing, finance, etc. At the beginning of the year 2022, they have forecasted data of demand of their shoes for beginning of the month of March is 1000 pairs. So at the beginning of March, they have forecasted for 1000 pairs. What is their demand? Beginning of month of March is 1000 pairs according to them. But the actual demand turned out to be how many pairs? 900 pairs for March. So at the beginning of the period it was 1000, but at the end of the period they realized that actual is 900. Use a smoothing coefficient of 0.1. So smoothing coefficient is also given. Forecast the demand at the beginning of second week of March 2022. second week of March 2022. So you have to start from where? Beginning of from March you should start. This is March, first month of first week of March. No, they are asking you to calculate second week of March. Which value? Forecasted value. Also forecast the demands using exponential smoothing technique at the beginning of each week till mid-April 2022. Not just second week of March, till mid-April 2022 when the actual demands are as follows. So at the beginning of second week of March it is 1010 pairs. At the beginning of third week of March it is 1032 pairs. At the beginning of fourth week of March is 976. At the beginning of first week of April 934. Second week of April 1008 pairs, and at the end of second week of April is 1020 pairs. So always they should give you previous period what is the forecasted figure. For that purpose only they have given that. So let me show you now how to calculate now these forecasted figures. So forecasted value to be used for March first week is equal to the previous forecasted value. Assume that this is only given as 1000. So in the question they have given now 1000. What is this 1000? At the beginning of the year 2022, they have forecasted data of the demand shoes for the beginning of the month of March. See, beginning month is nothing but previous period end now. Yes. So I am starting with now this only. So this is the formula as you all know. Mu t is equal to mu t minus 1 into alpha into yt minus mu t minus 1. So let us take the months now. March month, week number 1. So mu t minus 1 is nothing but previous period. What is the previous period here? Previous period forecasted value is 1000, which is already given in the question. Now we have to calculate yt. Yt represents what? The actual figure. The actual figure. What is the actual sales for the month of March? How do you get actual? That is also given in the question only. What is the actual sales for the month of first week of March is actual demand turned out to be 900 pairs. So yt is actual demand. This is your actual demand. Actual demand, this is. Actual demand. What is this mu t minus 1? Previous period forecasted values. Previous period forecasted values. Previous period forecasted values. FU means forecasted values. So which is already given in the question. Forecasted is 1000 and actual is 900. Now what we need to do is we need to calculate now what is the forecasted value for what? What is the forecasted value for current period? What is the current period? First week of March. We know previous period forecasted value, previous week. We know current period actual, but we don't know current period forecasted. Okay, that is what only we should calculate. Right? Yes. So before that, let us calculate even this value also. Which value? The difference between actual value minus previous forecasted value into alpha. So yt represents the current actual figure or not. Actual demand is what is the actual demand? 900. According to the formula now, let me calculate here. 900 minus previous forecasted value is how much? 1000 into what is the alpha here? 0.1. So how much is this? 900 minus 1000. 900 minus 1000 is minus 100. Minus 100 into 0.1 if you do, then you will get what? Minus 100 into 0.1 is minus 10. Okay. So what I have done here is separately I have taken everything. First we have taken the difference between these two. yt minus mu t minus 1, because in this formula we require these two, no? This one, yt minus mu t minus 1, the difference between these two I have taken. Then we substitute in the formula. So mu t, how do you get? Mu t minus 1, this one 1000 plus this into alpha 0.1, if you multiply minus 100 into 0.1, that is minus 10. So 1000 minus 10, 990 is the forecasted value of current period represented by mu t. Notations properly you should use. Okay students, so like this for every week we need to do. So March first week we have taken, March first week beginning of nothing but previous period, that is. So previous period forecasted value, mu t minus 1 represent previous period forecasted value. Yt represents actual demand of current period, 900. Then take the difference between these two. Then substitute in the formula now all the figures. Now mu t minus 1 previous period forecasted value is 1000 plus yt minus mu t minus 1 is 100. 900 minus 1000 is minus 100 into 0.1, smoothing coefficient, 990 you are getting. Now for second week of March, what is the previous period forecasted value? Already we calculated first week forecasted value or not? Yes, 990. This only we should take it as the previous period forecasted value. What is this? I will write previous period. FU means what? FV is nothing but forecasted value. So interlink is there. So this 990 only we will take it as the previous period forecasted value. And what is the actual demand of March second week is given in the question only. Look at the question. At the beginning of second week of March, 1010 pairs. This only we should take it as the actual. So 1010 you can take actual. Then difference, substitute in the formula. So like this third week, fourth week, April first week, April second week, April, mid of April they gave. Now mid of April means April 15. So approximately we can do only second week of April. We cannot go to third week, no. So April second week end only. First is April second week we are taking. April first week is over. April second week. Second week beginning we are doing. Remember, each one we are doing at the beginning only. Remember, in this question everything is given at the beginning only. So here mid-April second week beginning is over. Now they asked you to calculate up to end. So second week end also we should calculate. That is the important thing here in this question. Second week everything is at the beginning only we calculated. Now they asked you to calculate till the end, no, mid-April end. The second week end also we should calculate. Now second week end, what is the previous period? Second week beginning, nothing but previous period. So 990 we will take. And for this period, what is the actual? Second week end is nothing but third week beginning, no, April third week beginning. What is the actual figure they have given? See the question. At the end of second week of April, it is 1020 pairs. End of second week, not beginning. End of second week is 1020. Yes. So that is what you should take it as actual here. 1020 actual end of second week. Difference between these two, then substitute in the formula, 993. Done, my dear students. So you should be little careful. We are taking at the beginning of each period. And other question now, similarly other question you can solve. So they have given quarterly here. The difference is earlier we calculated week wise, here quarter wise you should take. 2023 and 2024. Tonib Limited, dealing in logistics business, has a business wing named Ship Unloading. During the year 2023 and 24, they have the following quarterly figures in tonnage of material unloading from ships. So material unloading is the variable here, and quarterly they have given time. Use a smoothing coefficient of 0.1. So what is the smoothing coefficient? 0.1 required. If the forecast for the first quarter of 2023, always they should give you first quarter, no? Yes. 195 tons is the forecasted value. Assess the forecasted figure for the first quarter of 2025. Which one? First quarter of 2025. Nothing but after this last quarter of 2024, next one more also we should calculate, which is nothing but what they are asking you to calculate, forecasted value of first quarter of 2025, which is nothing but a previous quarter forecasted value only, no? Previous quarter forecasted value. Okay, please be careful. Now I am doing it for 2023 here. What are the figures we need to, what are the column heads we need to take here? Just I am showing you the columns here. Quarter, then we should take the first quarter. If you take what we require here, forecasted values. Forecasted value of previous period, we will represent it by mu t minus 1. And we should take actuals for the period, actual unloading, actual material unloaded, YT. Okay, so if you take first quarter now, what is the previous beginning of the first quarter they have given now? If the forecast for the first quarter of 2023 is 195 tons, 195, and what is the actual first quarter? 200. Okay, now you can calculate forecasted value of current period. Current period forecasted value is equal to mu t. How do you get mu t? Previous period forecasted value, mu t minus 1 plus alpha into yt minus mu t minus 1. So this is equal to mu t minus 1 is 195 plus smoothing coefficient is 0.1 into yt is 200 minus 195. So how much is this 195 plus 5 into 0.1? So 0.5. So it is 195.5. So this is the forecasted value of which one? First quarter of 2023. We have to calculate all this now, because next again depends on this only, no? Next second quarter. Second quarter again the previous period forecasted will be which one? 195.5. Next, what is the actual for second period is 188. Then again 195.5 plus smoothing coefficient is 0.1 into difference between 188 minus 195.5. Like this for all the quarters you should do, including 2024. Like this still you have to go to till 2024 last quarter. Whatever is the last quarter of 2024 will become, assess the forecast figure for the first quarter of 2025. The forecast figure of see here they have given the forecast for the first quarter of 2023 195, that only we have taken as this one, no? So similarly 2025 if you want first quarter, then naturally 2024 fourth quarter forecasted value only will become 2025 first quarter forecasted value, no? Yes, so that value only you should take it as the answer. Okay, you have to proceed till 2024 last quarter whatever you get forecasted value, that is only the first quarter of 2025 forecasted value. Okay, done. This is exponential smoothing coefficient method in measuring the trend. This is the third method, my dear students. So with this we have completed 3 methods for trend measurement. 3 methods for trend measurement. Now we are moving on to seasonal. Next one is methods for measuring seasonal variations. In fact, we have only 4 methods. Deseasonalization is it is not a method here. So in fact these 4 methods are very important. So to measure the seasonal variation we have these methods. What is the first one? Is simple average method. Second one is moving average method. Third one is trend ratio method. Fourth one is link relative method. Fourth one is link relative method. Now, before we go to this, my dear students, one thing what you should understand is, when you are measuring this seasonal variation, we should calculate the seasonal index. What we should calculate? Seasonal index. Right? Remember this in your mind. Okay, whenever you are measuring the seasonal variations means due to seasons, the festivals, or the whatever weather changes that happens. Yes, due to that we are seeing the changes in what? Our sales or profit. So to measure that, generally we measure it by index only. Alright, so since it is a revision class here, I am not going to the the basics part there. I am just trying to explain that what is the logic behind taking those indices. Whenever you are measuring seasonal, whenever you are doing seasonal variation problems, they use the word seasonal indices. That is what you should remember. Seasonal indices. They ask you to measure the seasonal indices quarter wise. Okay, and you know that the seasonal variations we will have over the quarters or months in a year. Seasonal variations we measure for the quarters or months in a year. So what are the methods we have is simple average, moving average, trend ratio and link relative method. So quickly we will see all the methods. First one is simple average method. We know that we have two models. Now time series we have additive model and multiplicative model. Additive model and multiplier, both I am showing you simultaneously here. Simple average method. When you can apply this simple average method is for measuring seasonal variation. When you find no trend at all, that means fluctuating. The sales or profits are fluctuating. There is no clear-cut trend. Then you can use simple average. So under simple average, how do you calculate the ultimate seasonal indices? Okay, is through these steps. So what is step number one is, whatever quarter wise they have given, like this they are going to give you quarter wise sales, profit, year, and each year again quarter wise you will have 4 quarters. So first take now, assume now there are 4 years quarter wise they have given you sales. 1, 2, 3, 4. So this is the format what you need to follow. So 4 quarters sales they have given for all the 4 years. So first what you do is, find the average of the given data for each quarter, for each period. So what is the period here? Quarter wise we are doing it. So first what you do is Q1, add all the, for every year all Q1 you add, get the total. Similarly Q2 total, Q3 total, Q4 total. Even if it is multiplicative also, step number 1 is same only, whether it is additive or multiplicative. For every quarter get the total. So find the total first, then take the average. How do you get average? So 1, 2, 3, 4 are there. So total divided by 4 if you do, then you will get average. So you can call that as A1, A2, A3, A4. So that is the average. Okay, that is step number 1. Then, so what is, just let us try to understand what is the logic behind this. What is this average is, whatever data, sales data or profit data in a year will have a effect of cyclical fluctuations also. Even trend effect also you have that in that data. In the sales data or profit data, do you think only seasonal effect will be there, or even trend effect also will be there? Trend effect also will be there, right? Or even cyclical variations also you can see. So when you average figures, no, what will happen is we can remove the cyclical variations and trend variations. That is the logic behind this averaging. Okay, then what you do is, step number 2 is, take the grand average, average of average. So these are the average now, 1, 2, 3, 4. Take the average of this. So A1 plus A2 plus A3 plus A4 divided by 4. So even under multiplicative model also same thing only will do. So get the grand average. Get the grand average for this. So say for example you got 1, 2, 3, 4. So 1, 2, 3, 4 plus divided by 4, you will get the grand average 2.5. So that is step number 2 under simple average method. Get the grand average, average of average. Then step number 3, we need to calculate the seasonal indices ratio, or if it is additive model they will use the word seasonal variation or deviation. If it is additive model, okay, call it as seasonal variation, deviation or variation, or if it is multiplicative model, use the word seasonal indices ratio. Okay, so how do you calculate the seasonal variation or seasonal indices? Is just take the difference between average and grand average. So what will happen when you take the difference between average and grand average? So I took one example now, 1, 2, 3, 4 we got. So what is the grand average of this 2.5? Now what I have to take is the difference between 1 minus 2.5, 2 minus 2.5, 3 minus 2.5, 4 minus 2.5. So when I take this average minus grand average difference, ultimately the answer will be 0. That should be equal to 0. If you want, you can check. 1 minus 2.5 will be how much? Minus 1.5. 2 minus this one, minus 0.5. 3 minus that one, plus 0.5. 4 minus that one, plus 1.5. So ultimately the sum will be equal to 0 or not? Yes. So when you do this seasonal variation, that is average minus grand average, if you are using additive model, right, that must be equal to 0. If it is 0, there ends the problem. Similarly, if you are following multiplicative, this is most important, students. We have to find out the seasonal indices ratio. How do you get seasonal indices ratio? Is we should divide, instead of subtracting, average divided by grand average. Remember, for most of the methods, this is what is common. Simple average method is very important even for other methods also. So average divided by grand average, if you take average divided by grand average, what you will get? 1 divided by 2.5, 1 divided by 2.5 plus 2 divided by 2.5 plus 3 divided by 2.5, if you do, ultimately we will get 4 into 100. If you multiply 400, you will get. Yes, that should be equal to 400. Check here. 1 divided by 2.5 into 100 you do. Next, second quarter. Second quarter average is 2. 2 divided by again grand average 2.5 into 100 you do. So like this, if you do each one, ultimately you will get 400 only. So if that is equal to 400, there ends the matter. But if it is not equal to 400, say if you have more than, say 425 you got. So that extra 25, what we will do is, we will adjust among the 4 quarters. How do you adjust that? If it is additive model, how do you adjust? Additive model, it should be equal to 0. If it is not equal to 0, it must be 0. Otherwise, go to step number 4. So what we should do? Correction we should do in step number 4. Whatever difference, say for example you got 2 here, that difference divided by 4 quarters you should spread. No, adjustment you should do it for 4 quarters. So divide by 4. Here what we should do? How to take that correction is, if you get 420, then what we should do is, to get 400, what we should do is 400 divided by actual total. Step number 3, whatever is the actual total. What is the correction factor here? 400 divided by the actual total of step number 3. Say here you get 420. Then what you do is 400 divided by 420 you do. Whatever factor you get, that factor you multiply with step number 3 figures. Basically we are trying to get total 400. That is what. Here if it is additive model, we are trying to get 0. If it is multiplicative model, ultimately we are trying to get 400. Whatever is the difference between 400 and other figure, whatever you got, that we are trying to adjust among the quarters. That is what we are trying to do here. So whatever is the factor we are getting, we are call it as correction factor. If it is multiplicative model, 400 divided by the actual total of step number 3 you take. Then that factor you multiply with all these step number 3 figures. A1 divided by average divided by grand average, you get figure, no, that into this correction factor you do it. So that means what I am doing, I am adjusting for every quarter. So if it is multiplicative model, multiply this corrective factor with step number 3. If it is additive model and then subtract from step number 3. Then ultimately it will be equal to 0. That will be equal to 400. Understood? Yes. These are the steps. So first step is take the average of each quarter, then take the grand average. Then if it is these two steps are same whether it is multiplicative model or additive model. Step number 3 is you should calculate seasonal variation or seasonal indices. For additive model, seasonal variation. For multiplicative model, it is seasonal indices ratio. So if it is seasonal variation additive model, it should be equal to 0. What is equal to 0? Whatever average you got minus grand average, it should be equal to 0. Whereas in case of seasonal indices ratio, average divided by grand average, okay, into 100 for all quarters, the total must be equal to 400. If that is not the case, then what we should do? Then we should find out a correction factor. Correction factor is nothing but the difference we are trying to adjust among every quarter figure, step number 3 figure, so that ultimately we get the desired result, that is 0 for additive model and 400 for multiplicative model. So let us take one question, my dear students. Here I told you that when we can apply simple average method, only when you don't find wide fluctuations, when you don't find any trend in your data. See the question now. This is how you should recognize that it is trend related question, not trend, seasonal related, seasonal variations related question. Calculate the seasonal indices for the following quarterly data in certain units. Calculate the seasonal indices for the following quarterly data in certain units. Appropriate method for finding the indices has to be decided by you with due explanation. So which method we should apply? You should only decide. Calculate the seasonal indices. Clearly given seasonal indices. That means seasonal indices means multiplicative model or additive model? Multiplicative model. Seasonal indices means ratio, no. So we should use multiplicative model only. So they have given here for the following quarterly data only. So 90, 92, 93, 94, 95 for 4 quarters they have given. If you see, observe this data now. 39 you have sales, then 21 down, then again increase, then again increase. So you don't find any trend here. You can see here 45 down, up, increase. So there is no clear cut upward trend or downward trend. So here we can use simple average method for measuring the seasonal variation or seasonal indices. Under this, what is the first step? Get the average of each quarter. Average of each quarter. Then step number 2 is grand average. Step number 3 is seasonal index must be equal to 400. So that is what we have written here. Answer: as the quarterly data does not have a wide fluctuation, we are using simple average method as there is no trend. We are using multiplicative model as the requirement of the question is seasonal indices ratio. Why we are using multiplicative model? Because ratio they have used, no? Yes. So take the quarter wise sales, whatever is given, first get the total, then divided by 4, then you will get average of each quarter. Then get the grand average. How do you get grand average? Average of average. That means take the total of all these averages, 209.5 divided by 4 averages, no? So grand average is 52.375. Now how do you get seasonal indices? Average divided by grand average into 100. Average is 45.25 divided by 52.375 into 100. How much we got? 86.4. Second one 44. Third one 118. 150. So if you add all these three, ultimately we got 400. So directly we got seasonal indices 400 only. There ends the matter. So this is only your seasonal indices ratio. So my dear students, here generally these indices nothing but index numbers. So index numbers tells us what is the percentage increase or decrease when compared with what? Other quarters. When compared with other quarters, what is the increase or decrease? So in the form of index we will take to represent that. Okay, so little bit of logic also I try to explain why we are taking averages to remove the cyclical effects and trend effect. Then why we are calculating this ratio is to calculate in percentage term. to let you know what is the variation, increase or decrease between quarters. So this is your first method, my dear students, that is simple average method. Second one is method of moving averages. What is that? Method of moving averages. So here, as I told you, that the data whatever is given quarter wise, whether sales given or profit is given, that will have the effect of trend. It will have the effect of trend as well as what? Seasonal. So if you want only seasonal here, first of all what we need to do is first you remove the trend effect. So how to remove the trend effect? You have to remove the trend effect. Then you will get what? Seasonal. Once you get seasonal figures, then you can follow simple average method. These are the steps. Okay, I am repeating. First you should get what? What I told you. First you find out how much is the trend effect. So for that we should calculate trend values. Which one we should calculate? Trend values. According to which method we should calculate? Moving average. Which average? Moving average. So first we should calculate, and why we are calculating only 4 quarterly? Because 4 quarters are there now. So you should use only 4 quarterly only. Since it is 4, you know that centered moving total also we should take or not? Yes. So you should first get the trend values. Trend values is nothing but method number 1, whatever you have done, 4 quarterly moving average. Same thing you should do it now. Okay, so that for every quarter, quarter 1, quarter 2, quarter 3, quarter 4 for 1 year, next year, like that for all years, all quarters you should calculate what? 4 quarterly moving average. Ultimately centered also we should consider. Yes. Once you get those trend values, then step number 2 is the trend we have to eliminate, because we are assuming that our data will have both trend effect as well as seasonal effect. I want only seasonal. So I want to remove what? Trend. So if it is additive model, what we do is from the original values whatever we have, from that we remove the trend values for every quarter. Then you will get what? Seasonal value. This you should calculate year wise and quarter wise. If it is multiplicative model, how to remove that? Generally, how do you get y? Y is equal to t into s. Trend and even see, we are assuming that for this method. Now if you want only seasonal, then y divided by t. Y is what? S is equal to y divided, y represents the original value, divided by t is trend value. So original value divided by trend if you do, then you can remove the trend effect. That is the logic of that step. So once you calculate the trend values for every quarter using 4 quarterly moving average, take the original value divided by trend value. Done. Then after that you should continue with simple average steps only. What are the simple average steps? Once you get this seasonal values after removing the trend effect, then take the again totals quarter wise, take the simple average, then grand average, then seasonal indices ratio. Same as simple average from there onwards. Understood, my dear steps? So my dear students, so under this method, second method, that is method of moving averages, step number 1 is we are assuming that our data has the effect of both trend as well as seasonal. So that is the reason what we need to do is from seasonal effects, I want to remove the total figure, original figure, I want to remove the trend effect so that I will get only seasonal effect. So that is the reason first step is we should calculate the trend values using 4 yearly moving average. 4 quarterly, because we have 4 quarters in every year. Okay, so naturally if you remember 4 quarterly means first 2 quarters you will not have blank figures, you will have, yes, like this every year you have to do it. Even last year also 2 blanks you will have, yes. So calculate trend values, then what you do is original value divided by trend. If you take no trend effect you can remove if it is multiplicative model. If it is additive model, then original value minus trend values you should remove. That is your trend eliminated. What is this? Is elimination of trend. This is what I have written here is elimination of trend. So we have to make a new table now. Q1, Q2, Q3, Q4 original value divided by trend value for multiplicative model. When you should use multiplicative? When you use the word indices ratio. Additive, if he is not using ratio, then you can use additive model also. Then continue with simple average steps only. Final step we should get, again remember 400 or 0 here difference. Understood students? Yes. You can see in this I calculated first trend value here. 4 quarterly again means 2 centered also I should take, no. Like this 2005 I have done, 2006 also I have done, 2007 and then 2008 also I have done. So I got this 2 years, 2 items centered moving total also we should take. Then 4 quarterly centered moving total average I will get. Only for which one I will get? Q3 I will get, Q4 I will get. Again last 2 quarters also I will not get. See here. Q3 and Q4 I did not get. So these are your figures, forecasted values. These are trend values. From original values, remove this. If it is additive model, multiplicative model, divide. Just divide these figures. Then you will get revised table like this. So here trend eliminated values. Seasonal value minus original value minus moving average. Additive model I have applied here. Additive model here. So then take again simple average steps only. Average you take, then grand average you take. Then make sure that difference is 0. If it is not difference, if it is not equal to 0, then what I told you, then whatever is the difference is there, that you spread across 4 quarters. Okay, then you will get 0. So you should spread for all quarters. You should adjust for all 4 quarters. See here how much we got. We got 0.04, no, not 0. So that 0.04 you spread across 4 quarters. You will get 0.01, 0.01, 0.01 only, no. So deduct from every figure. This figure you deduct 0.04. Already it is after dividing 4 only. 0.17 is the actual year total. So that if you divide by 4 quarters, you are getting every quarter how much you should adjust? 0.04. If it is multiplicative model, what we are supposed to do? 400 divided by whatever actual value you got, that is a correction factor, into that average you should multiply if it is multiplicative model. So that you will get 400. Then students, this is moving average. Then third one is deseasonalization. Deseasonalization is nothing but like removing trend. Earlier we have done removal of trend or not? Yes. So as we know that our original data, that is what I was telling you earlier also. Original data consists of both multiplicative as well as, trend as well as seasonal, no. So what I need to do, I need to remove trend or not? Yes. If you remove seasonal effect, then I will call it as what? Deseasonalization. So what is, see here, deseasonalization, it means elimination of seasonal variance. It means what? Elimination of seasonal variance. Nothing but seasonal effect or seasonal indices. So if it is additive model, how to remove that effect? Original data minus seasonal variation. This is how we remove that seasonal effect. If it is multiplicative model, how to remove this seasonal effect is, we know that it is, we will have both the effect now, trend effect as well as seasonal effect. If you want to remove seasonal effect, then how do you get that? Seasonal effect if you want to remove, then y divided by t. Y divided by t here. So original data divided by seasonal indices. You should take original data divided by y divided by what? Seasonal you will get if you want t. If you want only trend value, because you want to remove seasonal effect, no. So only want trend. What do you want? Only trend. Deseasonalization means what we are doing? We are removing the seasonal effect. So you should take original data divided by seasonal indices you should take. Okay. That is called as deseasonalization. Then estimation of sales, how do you get is, now you should include the seasonal variation or trend values now. So if it is multiplicative model, trend value, because earlier after removing seasonal, what you have? Trend values. So the trend value multiply with seasonal effect. Then again you will get estimation of sales. Just read this carefully, you will understand. Even one question also I have done here. Deseasonalization. From original value, you should remove the seasonal variance. Okay. So if you refer to your CMA material, you have one question also, you can do that question. So that is which method? Deseasonalization. Basically deseasonalization means removal of seasonal effect from your original data. We call that as deseasonalization. Then again, if you want to estimate sales, after removing seasonal effect, you will have only trend effect. To the trend value, add the seasonal variance. Then you will get what? Total data. Now we are left with ratio method and link relative. Let us go to that. Trend ratio. Method number 3 is trend ratio. So trend ratio here, ratio represents what? Multiplicative. Ratio, whenever they use trend, whenever they ask you trend ratio, that means they are asking you to use multiplicative model. So under multiplicative model, assuming that our original data will have the effect of trend as well as seasonal. So now I want only trend. I want only trend. Then y divided by s. If I want only seasonal variance, then y divided by t. So what I will do is under trend ratio method, I will remove the trend effect. What I will do? I will remove the trend effect. If you want to remove the trend effect, then I want only seasonal. So then y divided by t. So original value divided by trend value. This is trend ratio. How do you calculate trend ratio? Trend ratio represents basically elimination of your trend effect in the original data. So if you want to remove in multiplicative model, always we should divide the trend values. Now this trend value, how we should get is using method of least square. How do you get this trend values? Using method of least square. That is the thing here. When you are calculating this trend ratio, the trend values we should calculate not by moving average. Using which one? Method of least square. Already we have done while knowing the measurement of trend. We know that if you get especially x value, capital X value, if you have even number of odd number of years, middle year, easily we can take origin. Even number, if you get then 2 middle years, we take average. Yes. So what we do is when you are calculating this trend value, first we will get yearly trend value. What you will get? Yearly trend values, no? Yes. Then we need to convert them into quarterly trend values. That is quarter wise we need to convert. That is one important thing. When you are doing this trend values, you should convert them into quarterly trend values. How to convert them into quarterly trend values is here is, see here, important step this one. Yearly trend values, you should convert them into, why do you require trend values? Because I need to remove trend effect in my original data. Using which method we should get trend effect? In trend ratio method, method of least square. So get the trend values quarter wise. How to get that is, first you take year wise whatever we got trend values. Above we'll get year wise, take them. Okay. These are the trend values. So now how to convert them into quarterly trend values? How to convert them into quarterly trend values? Yes. In this, the first year trend value, take it as A. First year trend value, take it as A. Okay. Whatever you got trend value, yearly value, take it as A now. Right. Now for every quarter I should take or not? Yes. Now how to get every quarter is, first if you want to get trend 4 quarterly means again average. If I take mid value, this is the mid value. Yes. So first to take A value here between Q2 and Q3. What is A value? A value represent first year trend value. Take that figure here. Then if you want to get Q2 trend, how to get Q2 trend is, Q2 trend from this yearly, what I need to remove? I need to remove the trend. So how to get that is, if I am going left hand side, if it is minus, if I am going left hand side, we know that we have to subtract x. Remember, do you remember the x? Right hand side if you go, we need to add. First you remember that. Next is how much adjustment we should do for yearly is, how much adjustment we should do. See, depending on the origin, that is, the place is in between Q2 and Q3. Between 2 quarters I have or not? Yes. So first of all, what we need to do is, if you want to get quarter wise trend effect, what we need to do is, slope also plays a very important factor. Slope also plays a very important factor. So whatever slope you get B, that you should spread across how many quarters? 4 quarters. So B divided by 4, that is the quarterly change. Slope, what is the slope? Slope of trend equation. B represents the change. B represents what? Change. So from this A, what I need to do is, B represents what? 1 quarter change. B represents what? Capital B represents 1 quarter change. But this Q2 from here, exactly in middle, no. We should not take 1 quarter, half of a quarter. So that is the reason B divided by 2 I have taken. This side again from here half only, no. Half of a quarter from here to here. So that is the reason B divided by 2. So plus B divided by B represents what? Every quarterly adjustment of slope. Everything I have written, read it carefully, easily will understand. Notes I have written, my dear students. So easily you can understand. So here half I should take. Why I applied B by 2? I think you might have got it now. From here to here, 1 quarter means B by 4. But half a quarter means half of that. That adjustment you should do. Then remaining quarters from here to here, 1 quarter only. This is between this and this again. Between this and next, one more important one is, if you want to get this Q2, take from A minus B by 2. This you call it as A1. Then how do you get Q1? Take this A1 minus B value, 1 quarter effect, B effect. Okay, then here A plus B by 2, because half quarter this one, adjustment we should do for slope. This one, this value plus B value. You only think, easily you will understand what is the logic behind this. So now we got the trend values quarter wise. Once you get trend values quarter wise, now how do I get trend eliminated values? Very simple, original value of each quarter divided by the trend values whatever we got for every year, every quarter. Divided by that, then you will get what? Trend eliminated values. Then apply simple average. From there onwards, what do you do? Simple average steps. Average, grand average, then average divided by grand average, seasonal indices, is equal to 400. That's it. That is what you should do. Right, students, one question here, question number 13. Solution to question number 13 I have given now here. So you can understand through this answer what I have done exactly, how I adjusted this trend eliminated original trend values, how I got here, see quarter wise. By referring to this answer, easily you can understand. Refer to the steps and refer to the solution here. I will attach the question also here to this answer. Question number 13. See here what CMA metal question only this is. So you can refer to CMA material, right? I will make sure that that question is pasted here, so that you can refer to this question and answer also, so that you can understand those steps with this practical solution. And under link relative method, last one is link relative method. With the help of example only, I took an example and each one steps I have given along with the values. So under link relative method, first what you should calculate is link relative values you should calculate. How to calculate link? So if you want to calculate Q1, we cannot calculate, no link prior to that. Q2 link, 65 divided by 60. Original value divided by previous quarter values. So that is the first step. Link relative value should calculate. Current value divided by previous value. For all the quarters we should do it. Okay. then we should get the average of link relatives. Average of each link relative you should get. Then third one is very important, that is chain relative you should calculate. Chain relative. Chain relative, how do you calculate chain relative is the average link relative whatever you got into chain relative of previous quarter. Chain relative, here we are trying to get the chain effect between the quarters. Chain relative of previous quarter divided by 100. This is how you get chain relative. For the first quarter, since we don't have previous quarter here, we should assume it as 100. First you take it as 100, this one. Then you can calculate for the remaining. So how do you calculate that? Average link relative 116.74 into chain relative of previous quarter is how much? 100. 116.74 into previous quarter chain relative is link relative is link relative of current quarter into chain relative of previous quarter divided by 100. Like this for every quarter you should calculate. This is called as chain relative. If you see here, first one we did not calculate real chain relative value. Based on this only we calculate for rest of the thing. Now what we should do is, now we should calculate the chain relative of first quarter using the last quarter. Yes, that is what we should do. That only we call it as a second chain relative of quarter one, or we can also call it as corrected chain relative. So how do you get, what I told you, using this last quarter we should get chain relative of first quarter. So how do you calculate that is average link relative of Q1, this one, into chain relative of Q4, this one, divided by 100. So I got 99.4. Actually I should have got 100 here, but I got what? 99.4. So now how much we should adjust there? Correction factor is nothing but deviation. So see, second chain relative of Q1 minus assumed value how much? 100. That you should spread across 4 quarters. So how much I am getting every quarter? 0.15 we should adjust. So how to adjust that is, this is how we should adjust. Q1, how to adjust that is, whatever we got, second chain relative of Q1, this is a second chain relative, no? 99.4, to that only we should adjust. Minus D into 4. What is D? D is the correction value into 4. Why we are multiplying with 4 here? From quarter 4 to quarter 1, how many quarters we have? 4 quarters. Alright? Yes, directly. Then quarter 2 to quarter 1. 1 only we have no difference. Chain relative. So you can directly take 1, 2, 3. So this is how you can calculate the corrected chain relatives. Once you get the corrected chain relatives, then from here onwards again the same simple average step. Get the average of chain relative. It's like grand average only. Then calculate the seasonal ratio. That is seasonal indices ratio. How do you get that? The CCR divided by average of the grand average, that must be equal to again 400. Right, students? So first what you should calculate under link relative method? First one is link relative you should calculate for this quarter divided by previous quarter. Then you should calculate average of that. Then chain relative you should calculate. How do you get? First one always chain relative you should take 100. Based on that only you calculate remaining quarters. Then you should recalculate chain relative of first quarter using fourth quarter. If that is not equal to 100, okay, then what you should do is you should find out the correction factor. Then using correction factor you should adjust these figures whatever you got, these figures and this figure. If we got this figure as what? Chain relative 99.4, this you should adjust, these three also we should adjust in such a manner that ultimately I will get 400. So this is the adjustment you should do. Adjustment also you remember. Then take the average of the chain relative, then get the seasonal index. This is link relative method. So please follow the question and answer. Easily you will understand. Till now they have not asked link relative method. Okay. So that's the reason I also did not spend extra time there. So important only I have spent lot of time. With this we have covered all models, my dear students. Thank you for your patience. So keep watching my videos to get more conceptual clarity in SCM. Thank you, students.